Thank you for clicking on our link regarding development exit finance. This is something we've talked about briefly some of our social media platforms, but we wanted to do something a little more detailed. It's an area of finance that we're finding massive growth in at the moment, partly due to the fact that the market's slowed down a little bit in terms of selling end units, and partly due to the fact that clients are needing to move on to their next projects before necessarily crystallising the profit in their existing project. So just to give you an overview, development exit finance is a type of short-term finance that is specifically designed for house builders, SME house builders in the main, property developers who use traditional development finance to do their developments on a case-by-case basis, usually within a special purpose vehicle, rather than larger house builders who have got revolving credit facilities with major banks or PLC funded. There's a number of reasons that a SME house builder might look to use a development exit finance. One might be that they've got a cash flow shortfall within that specific development and that specific business. One might be that they need to repay the development finance facility that built that development. And the third may be that they've got working capital needs outside of that development, potentially to move on to their third project. Whichever the reason, the product is quite similar, and it's quite a bespoke product in many cases. Some people see development exit finance as just another bridge, which in some cases it is. If you've got a scheme of 12 houses and you've sold 6, and the other 6 are yet to sell, you could just take out a traditional bridge on the remaining 6 at, let's say, 75% loan to value, and use that money to pay down your development facility, and any surplus would be then available to you to move forward with working capital on your next project. Where the products can become a little bit more niche is where they are specifically designed for SME house builders. So an example of that would be how the sales proceeds of in this example, the second set of 6 houses are distributed. With a traditional bridge, as you sell each house, all of the proceeds from that sale will be repaid to the funder and pay down your debt. With a bespoke development exit bridge, what we would typically find is somewhere between 25 and 35% of the sales proceeds would be released to the borrower as part of their profit. So we see the profit being released as properties get sold across all 6, which gives much better cash flow for property developers. There's also quite a lot of niche areas depending on the products itself. Some development exit lenders will do part complete stock. So it might be that you've got wind and watertight, first, second fix, and you either need a bit more money to finish the scheme because costs have gone up since you set up the development finance facility, or it might just be that you just, again, need to bring that profit forward to move on to your next scheme. We've also done recently a hybrid model, which was a scheme that was, in some cases, units were complete. In other cases, units were part complete but were wind and watertight and at second fixed stage, and the third set of properties hadn't actually been built. And we put together a bespoke product with one of our finance companies, which allowed us to borrow against all 3 of those different stages of the asset and release a quite considerable amount of funding. That funding was used to repay the development funder and then move forward and buy the next site for the developer to move forward with. There's varying opinions on development exit finance. Historically, and I've been a proponent of this, it's used to be used very much where the market was slow and products weren't selling. And we're seeing that at the moment as the market slows down slightly, and traditionally easy to sell properties in good areas like North Yorkshire, West Yorkshire, where we operate, are taking longer to sell. But it's also a way of managing cash flow. And even if you are comfortable that your products are going to sell, that pipeline at the moment can take 3, 4, 5 months to turn, even with a willing buyer. So it just gives the opportunity for SME house builders to access their own profit sooner. And the final one to talk about, I guess, is where things haven't gone quite to plan, where the development finance period has been too short, and you've got the properties finished, but that you haven't been able to get them on the market and sold because you've maybe set a 12-month development period, and it's taken 15 months. Some development finance companies will extend sensibly in terms of the rates and the costs. Others quite understandably want their funds back within the time frame. So development exit finance can then allow you to alleviate that problem and buy more time. One thing I would say is it's important to model the different scenarios before you go into development exit finance. Once you've got a quote from us to do development exit finance, I'd always recommend going back to the development finance company and ask what the alternative costs would be. What would the fees be for extending your existing facility? What would the interest rates be? And we're quite happy to help you model those two options. If it's cheaper to stay with your development finance company, then that is the best option for you, and we would always recommend that.